Hey everybody, this is Jose here. We are about to start, around 20 seconds to go. Please, this is a sound check. Go ahead and confirm with a quick message on the chat box that you hear my voice, and that would be my confirmation. So I know you hear me and we are ready to start. Wonderful guys. Wonderful everyone. Very good. So reaching the end of the countdown, so closing the windows that we don't need, and here is the starting page, as we always start with our introduction page. How are you everyone? Good to see you all. Tui Conde, welcome to the group and the UFO community. A pleasure to have you. It seems that you are joining us, I would say, for the first time. So very nice. And hello everyone as well, of course. Super pleasure to see you all in this Thursday session. So let's begin. My name is Jose Blasco. I'll be your guide. Today is 11th of July 2019, and we are getting together for longer term trading and any opportunity that we identify which is above and beyond intraday trading. Okay, so normally the trades we execute are going to be multiple day trades, but if we find something longer term as well, we'll certainly analyze it and be ready to go for it. Okay, so super pleasure to have you all here. And before we begin, as always, disclaimer. So let's go for it. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this would conclude the disclaimer and therefore the introduction for the session, and therefore we are ready to go. And I'm excited, okay? And I mean, I'm always excited to get together and trade. And when I do it in the group with all of you guys, it's even more exciting. But today I'm a little more excited, if you wish, because the more time we spend together, the more advanced we get, and the more advanced we get, the more fun it is, isn't it? And last week it was 4th of July, and the markets were closed, so we took advantage of our get-together session for trading, and we went ahead and we kind of converted it. It was a hybrid between trading and sharpening. That's what we did last Thursday, isn't it? And what we did last Thursday was to be a little more efficient and even more objective when it comes to building iron condors. Okay, so non-directional trades with options, iron condors. This is what we focused on last week. So I would like to start this week with practical application of what we learned last week. Okay, identify a few trades that hopefully will be good for us to execute, and from there then we'll move into the world of directional trading, long and short, and look for opportunities in that arena as well. Okay, dear Jose, can you explain quickly why the credit scanners very often show stocks or ETFs with a really low IV? Dear, it depends on what you mean with really low. Right? It depends on how you define what is a low IV for that particular stock. Because remember, the way we are scanning is in a way where we are looking for the top 50 stocks with the greatest IV and the bottom 50 stocks with the lowest IV for directional. Okay, and this is just a ranking of stocks that is being done by TradeStation based on pure IV, without looking at historical values of where the IV was or where the historical volatility was. It's just like at this moment in time, which are the top 50 and the top and the bottom 50. And to be honest, for the majority of trades that we execute, it's plenty and is good enough, because we are using short-term expiration dates, isn't it? We don't go too far out. Even for directional, maybe we are using around 60 days, something like that, and then we do spreads. So in other words, we are just managing the Vega very well by, Dirk, I know you are an options expert, so the Vega, when you do a spread, gets very well neutralized, and also the Vega is the less when the expiration date is the shortest. So because we focus on shorter expiration dates and all the time we're doing spreads, we end up with extremely reasonable Vega values that even if we didn't pick the very highest volatility stocks or the very lowest volatility stocks, it's good enough. Okay, so we don't need to be that perfectionist unless you wanted to trade Vega. okay, which that is another set of option strategies where you may be trading Vega, purely trading Vega, okay, which is not something that we are doing at the moment. Okay, guys, a quick sound check one more time. It seems that Al has lost the sound. Everything is looking good on my side, but I'm wondering if you could confirm that you hear me well, so I would feel better in this way. It's good here. Okay, so I guess that Al is having a little problem on his side. Yeah, so I'm sure he'll be refreshing his browser or something like that. Anyway, so let's continue. And I should say let's begin. And what I have here, I have been running the scan for non-directional opportunities. I ended up with a list of 21. And as always, I always add a little bit of experience on top of the scanning process. In this sense, experience, what I mean by that is basically I'm looking at stocks that have greater liquidity, and also not ETFs. For example, XLU, which is a great ETF, would not be the best for a non-directional trade because by definition, ETFs are low risk and therefore the premiums attached are very limited, even though in this case it's showing like it has some premium built in. Still, most of the times it would be disappointing. This is coming from experience. So you can try to set up an iron condor with XLU, and you will see that many times when you run our rules where we want to get at least 15% of the distance between strikes when we do a spread or an iron condor, isn't it? With the ETFs, almost always it doesn't work. And same thing with some stocks such as Coca-Cola, KO. Those stocks are kind of like such stable companies that is almost like an ETF on how I was going to use the word boring, maybe not too formal to use that word, but I just did. And the fact is that the premium attached, it's always, it could be interesting, but at the same time, when you compare the possibility for movement of those stocks based on what happened in the past, normally you end up with pretty disappointing results. Okay, so I'm adding a little bit of my own experience. Okay, if you don't have it because you have been trading options for less time, it's okay. As you practice it, you will get to understand which stocks are those. You probably know that stocks report earnings every 3 months. So every 3 months in a market, you got a whole market cycle. This will allow you to look at many stocks during 3 months. And if you do that for 2-3 quarters, maybe 1 year, that's 4 times. I'm telling you, if you are looking at stocks consistently during, 2, 3, 4 quarters, next thing you know those guys. Okay, you know what happens when you look at an option chain. Which are the stocks that got a wide spread, which are the stocks that got a narrow spread. You get to know them. Is that making sense? So this is what I mean when it comes to when I said experience. Okay, so stocks that I would like to begin with is, for example, Netflix. Okay, now of course, as always, when looking at stocks with high volatility, very, very quickly here, I need to bring into the equation briefing.com so I can input NFLX, so we can look at what is the I need to log in very quick here. Okay, so here we go. I'm just logging in. So we need to look at what is the earnings report. In this case is July 17, and July 17 is a problem because tomorrow is July 12, but the next Friday, which will be the next expiration date, is July 19. And what does that mean? It means that the only way for me to do an iron condor with Netflix would be to use tomorrow expiration. Okay, now tomorrow expiration will only carry 2 days of time decay, and therefore normally you would not find successful trades. Having said that, Netflix is a $300+ stock, and because options are a derivative that derive their price from the underlying, and the underlying is $381 per share. Well, in this case, we may find an opportunity, like it happened in the past. I remember we had a very successful trade once with Tesla, which is also a stock with a price point which is in the highest portion, if you wish, in the higher percentiles. And with those stocks, it's always worth it to go ahead and take a look at the lower time frames to see if we can make a trade work. Okay. So I am loading here the 55-minute time frame for Netflix, but remember, based on what we learned last week, what I also need to bring in is Option Station Pro, which I'm loading right now. and I need to bring it in because in order to, we clearly see on the chart that we got red UFOs and green UFOs, which is what we need, but also this is not enough. We also need to look at the statistical potential for movement of that stock and use options and use UFOs beyond those points. Okay, this is what we learned last week. So what I'm going to do here, it's load NFLX. Okay, so that's going to be Netflix, and the moment I load Netflix here in the option chain, it will give me the whole list of options available. I will ignore everything and focus only on July 12th because of the earnings report coming on the week after. Okay, on the 17th. So I'm just gonna right click, okay, and analyze sell an iron condor. I even didn't look at the chart yet, but the reason why I'm doing that is because by doing this automatically, okay, I'm gonna be able to come in here and say +1 standard deviation, -1 standard deviation. Sorry, I just picked on 2, 1, okay, and therefore I know that from today until tomorrow, Friday, which is the expiration, Netflix is likely to move between 386 to 379. I know that statistical calculation, which is very convenient for me because now what I need to see is, do I have UFOs above and below those values? And if I do, then I am all set for an iron condor where the beginning part of the plan has to do with probabilities, and then the fine-tuning and the real edge will be the UFOs. Okay, but instead of just pick random UFOs on the chart just because they're there, now I'm being a little more purposeful with where are those UFOs located at. Okay, so I got Netflix fully loaded. I got 50.68%. I also need, because it's a stocks and stocks are fragile, you heard me say that a million times, so I'm going to click on pre and post market to see what we got. And with the pre and post market, I got better performance. Therefore, this would be the specific session to be used. Okay, with Netflix we would use pre and post market, would be better than using regular session. Now the problem here is that I don't see red UFOs, and I want to know why is that. Okay, so we are not making all times high. So if I don't see UFOs, if I don't see red UFOs on this chart, it's because I need to load more data. Okay, so let's go for it. Instead of 1000, I'm gonna load 2000 bars. Okay, see if we got any UFO. Not yet. Instead of 2000, I will load 3000 bars. Let's see. Not yet. Instead of 3000, let's go for 5000 bars. So last time Netflix was so high. Okay, so we got the pending data here on the upper left now. So the TradeStation is downloading data. In the meantime, I want to go back and check one more time in the weekly time frame. Sorry, in the daily time frame. The last time we were at this point would be right here, which is July last year. So we were there like 1 year ago. Okay, we were there like 1 year ago. So I need to load enough bars. So I go back to 1 year ago. Okay, so TradeStation is still loading. Here we go. I'm gonna go back to 5000 bars. Move down. Not yet. Okay, I'm a little surprised here. Maybe I'm not doing the math correctly, but if every day is 6.5 hours, so we should have like 7 bars. Okay, 7 bars times 252 days, that is 1700 bars. So I should be fine. Maybe oh, here we go, that's where they are. I just had to push lower down. Well, this is gonna be a problem because the next UFO is very far away. So 414, if I look at the option chain, and certainly 414 is above 386. Okay, so 414, well, yes, it's gonna give me 2 little premium. Okay, if I load 20, so 4, yeah, it's gonna be giving me basically 0. Okay, so yeah, so Netflix will not work because I guess that there was a gap. We can maybe double check this. Yes, there is a major gap right here, as you can see. Okay, and therefore the next UFOs are much higher to this price, and therefore with only 2 days to expiration, we don't have premium enough. Okay, not a big deal. We're gonna go for the next one, and the next one I would like to check is Microsoft. Okay, Microsoft. So sorry, I just added an extra plus sign. Okay, so here we go, and now we're gonna go take a look at the earnings for Microsoft MSFT. Super liquid options with Microsoft, super liquid options. Yes, I see your comments, guys. Yes, you are correct. I'm using the 0.618. So we have July 18. Okay, July 18 is the earnings report for Microsoft. So we have exactly the same situation with Microsoft that we have with Netflix. Okay, exactly the same situation. Now with Microsoft, when looking at the daily time frame, we are making all-time high. Which means that there will not be any red UFO above price, and therefore, even though the condition for this market based on the scanner is valid for an iron condor, unfortunately we don't have red UFOs. Okay, so we'll need to go for the next one. Okay, so the next one in the list that will catch my attention is Goldman Sachs. Okay, Goldman Sachs also provides us with a high price point, which is nice for options, and also very or less liquid but still very nicely liquid options. Okay, so we're gonna look at Goldman Sachs GS. So loading Goldman Sachs, we are dealing here with July 16 expiration. Okay, so same story with Goldman Sachs and Microsoft and Netflix. We cannot use July 19, which is next Friday. We will need to use July 12. Okay, so Goldman Sachs, let me see. Goldman Sachs is not making all-time high. We may have UFOs above price since around November last year. Okay, so we certainly we may have a possibility here. With the pre and post market, I am quite disappointed with the figures. 43. If I turn on regular session, so what do we have? We have 48. You know, it's not ideal, and for a directional trade I would not be happy with this figure. But for non-directional trades, remember we said last week it's okay to be a little more flexible because we are dealing with the time decay and so on, so we may have a way to make it work. So let's do the same we did before. I will just go back to my option chain, input Goldman Sachs. Whenever it loads July 12, which we have it, I'm just gonna right click to analyze, sell an iron condor, and the reason why I do this is just so I have the opportunity to come in here and type +1, -1 standard deviation. So basically from today until Friday, we will be expecting price to remain between 207, 204. So the question is, on the chart, do we have UFOs? Okay, and it seems that we do have, we do. Okay, it seems that we do. So we have, if I was to be very precise, okay, if I was to be very precise and draw a couple of lines, okay, where the price is 204.27. Okay, so 204.27. Okay, and the next one is 207.31 above. So 207.31. Well, notice that if Goldman Sachs is likely to stay between those two lines from today until tomorrow, that's what statistics suggest, okay? But the fact is that we have a UFO, so if we were to sell options below 203.54 and we were to sell options above 209.02, then we will be in a situation where what we do makes sense from a probability standpoint, okay? Now, the only thing that is gonna be tricky in this case is that we also talked about damage control over the weekend, and obviously if you're going to do a trade which is a 2-day trade where you enter today and you're going to be out tomorrow, then there is no room to do damage control. So in this trade is either you're going to be right or wrong, and there is no offsetting possibility. That's what will happen when you use a 2-day expiration option. Okay, yes, Alton, a very good point with considering a bull put on Microsoft. Absolutely, that makes a lot of sense. So we can look at it later. We can look at neutral trades, neutral long, and we can certainly plan on that since we do not have the red UFOs. Good thought. Absolutely right. So so let's see what we have. Okay, so if I sell the 209, my biggest concern is the upper side. Calls normally always carry a little less premium. So if I do 210 would pay me 18. That's very small. Okay, that's very small. Normally we don't take less than 25. So 203.51 is the bottom part, and that would pushes us to go for the 202, for the 202.5, and that's 27. Okay, so doing it this way, doing this trade as an iron condor, will not work. Okay, will not work. I'm going to give you another choice. Okay, I'm going to give you another choice, and we'll see if it makes sense or not. I believe it will, but initially, based on what we have been doing most of the times in the sessions, you would buy a 212 call and you would sell a 210 call, and then below you would sell the 202.5 put, and then you would buy as a protection the 200 put. This is what would normally be what would be a, let's call it a normal iron condor using 12 July 2019 expiration date, because earnings happen on the 16th. Okay, so this would be the typical case. Okay, and you know what, since the market will open in 10 minutes, okay, and certainly this will be my favorite choice. So what I'm going to do is I'm going to have it ready here. Okay, I'm going to have it ready. So I'm going to get my we said the bottom part is going to be 200, and then 202, and then we're gonna do the 210, and then the 212.5. Okay, so this would be the condor that we will do. This one doesn't meet the rules. We're only taking 26. As you know, we have a rule where the minimum we will accept, okay, it's 25 when we sell options. 35 is better, 25 is the bare minimum, and as you can see, the 210, okay, pays us 18, which is obviously less than 25. So this is not a valid option. Okay, this is not a valid trade, but I'm gonna enter it here just to have it ready, just in case, because the market will open in 9 minutes, and when the market opens, everything will balance out, and when everything balances out, we may find out that there is more premium kicking in today, and we may have an opportunity. So out of being quick, I'm gonna leave the iron condor here, and I will uncheck it, but then I will come back to review the iron condor in a minute. What I will want to do as well, and this may work better, okay, so let me push the iron condor right here. Okay, so iron condor, okay, iron condor. Okay, what I'm going to do, and this is going to be the first time that I'm going to do this in the session. I think we are ready now, because, you know, I did talk about iron butterflies, isn't it, the other day on our damage control session. Okay, and since this trade doesn't have room for damage control because it's only 2 days to expiration, so then what I'm going to propose to do is to sell the 210, to buy the 210 instead of sell the 210, and then below we're going to buy the 202.5, okay, and then we're going to look at the midpoint, okay, and let me do this. Here we go. I'm going to look at the midpoint, and in the midpoint we're going to sell a call, and we're going to sell a put, and this is what's called an iron butterfly. Okay, now what's the midpoint? What's the midpoint? Well, if I take 209.02 plus 203.51 and I divide this figure by 2, I obtain 206.26. 206.26, when looking at the option chain, 206.26 does not exist. We have 205 or 207.5. That's what we get, 205 or 207.5. Okay, funnily enough, the one we need is the one in the middle, right? The one we need is the one in the middle. Okay, so we're going to do a complex iron butterfly. So what I'm going to do, and this is advanced, my friends, okay, if you're new in the session, just take it easy with me, okay? This is advanced, okay? So what we're going to do is the following. I'm going to sell. Let me write it down first. Okay. 207.5, 207.5. Okay. And I'm going to sell 205, 205. Okay. If I sell 207.5 call and put and 207.5 call and put, this is kind of like if I sold the 206.25, which is the midpoint. Okay. Now, of course, because I have double the options, I need double the protection. And that's what I got above and below. I'm having 2 of the 210 and 2 of the 202.5. Okay, again, this, my friends, it's more advanced than what we normally do. Okay, but this is a trade that may work, and if it works, again, we benefit of a super crazy fast rate of time decay between today and tomorrow without being exposed to any problem with the risk. Okay. Yeah, Brian, thinking out of the box here, isn't it? This is not a standard options application. We are going a little more advanced than what we normally do, okay? So let me do this, okay? I'm just gonna enter all of these one at a time. So let me just click on the right places. Sell, straddle, sell, straddle. I'm going to explain all of this in a minute. Okay, I'm just entering everything I need, and then I'm going to explain all of this properly on the analysis tab. Okay, so let me do this. Let me move this a little higher. Let me compress everything. Compress, 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 compress. Okay, and we'll start from bottom to the top. Okay, we start from the bottom to the top. So what we said is that we're going to buy 2 of the 202.5. Okay, so here it says 1. I'm going to have to make it 2. Okay, 2 of the 202.5 put. Okay, then we're going to do a straddle with the 205. So straddle, short straddle mean sell the 205 call, sell the 205 put. Okay, so if you think about it, I am right here right now. Okay, now we're going to do the straddle, the short straddle for the 207. So sell the 207.5 call, sell the 207.5 put. Okay, so this would be the next one. So I am selling the 207.5 call and the 207.5 put. Okay, that's called a straddle. Okay, and then on top, based on what I have on the chart, I should be buying 2 of the 210 call. Again, this is more advanced than normal stuff. 2 of the 210. Okay, and we have it here. Now, so here's the trade. Okay, so if you do this trade, okay, if you do this trade is likely going to pay you. Okay, this trade is likely going to pay you 270 and 264. Okay, so 2.70 plus 2.64, so you would collect $534 in premium, and then you would pay 18 twice, and you would pay 27 twice, because that would be your protection. So then you would pay 18 plus 18, and then you would pay 27, and you would pay 27. So you would collect a total credit of $444. Okay, this is the most you could make based on the credit collected, but it's not going to be like that. Okay, because if you are no matter where you are, give me a second, guys. Here, this is interesting. Let me see that. Okay, now yes, yeah, it was not showing 205, so now it's showing 205. Got it. Perfect. So because you may remember the risk profile from what we learned last weekend when we did sharpening. The iron butterfly has a risk profile like this. It's a little bit like a triangle, meaning that there is only one place where you profit the most. The normal thing is that you end up somewhere in the middle, and therefore this part in the middle is more likely to set where your profit is, where the peak would be great, but it's a little bit of a utopia type of profit, because you will need to end up exactly in that very point to get that profit. Okay, so this trade is not going to pay you the whole credit collected. Okay, this is what is very different if you compare an iron condor and an iron butterfly. With the iron condor, if you get paid for 44, you make 444. In this case, it's not the case. Notice how the risk profile tells you that the maximum profit here will be 195 if you end up in this center part, 195 in blue color, where if it ends up a little lower, You may make 49, you may make 104, you may make 160. On the other side, same story, 119, 64. So it depends on where you end up in the range, okay? And then the risk, as you can see, is calculated here as negative 305. Okay, so this trade has a risk of negative 305. The Iron Condor has less risk, okay? Less risk. The risk of the Iron Condor will be the distance between strikes, which is from 200 to 202.5. The risk is $250. In this case, this trade got $305 of risk, which is $55 extra compared to what the Condor would be, okay? But you also have greater potential for profit, okay? And a nice rate of time decay, making $64 a day on time decay, okay? Now, also the reason why you have more risk here is because you have double the contracts, okay? You have double the contracts. So with double the contracts, you have $55 of risk, okay? Extra, okay? So it's a valid trade. It could be a valid trade. Certainly it could be a valid trade, okay? So let me uncheck everything because the market just opened. So I want to recheck the Iron Condor. I want to see what's happening. Notice it seems that we got more premium. Oh, sorry, the midpoint is 2021. So actually it's looking like we have less premium, not more, but less. So probably it's not gonna work. 210 is paying you 16, 15, 16. So earlier it was 18. So the Iron Condor is formally discarded. We cannot do the Iron Condor, okay? So if you want to do a trade in this one, you're gonna have to do the Iron Butterfly, which in this case is not a normal Iron Butterfly, is a complex Iron Butterfly with 2 protections and 2 strikes in the middle, okay? So you can, to execute this, okay, you can certainly, let me see, I'm gonna drag it, okay, I'm gonna drag it, I'm gonna put it all together. So I'm dragging it to put it all together. Okay, so now I got 2 customs. Okay, so let's see if I can combine the 2 customs together. Here we go. Here we go. So now it's a big custom thing with 6 legs. Okay, 2 that are protection and all the other ones that you sell. Okay, and hopefully this also helps to clarify a little better what the trade is. Okay, so what I'm gonna do is to execute this trade. TradeStation does not allow for 6 legs orders. So to place the order, you will need to break it down, okay, into pieces. But certainly this would be a valid trade to be executed. Okay, so I'm just gonna place it the way it's gonna be better to get the best feel. The best way to get the best feel would be to get the calls in one side and the puts on the other side. So because we said the calls are gonna be 3, so I'm just gonna do a little trick. I'm gonna use ratio back spreads as the type of template for the order placement. Okay, and I know that to some of you, if you haven't been trading options for a while, I may be driving you a little crazy today because it's more advanced, but this is somehow what we need to do too, right? I need to kind of pull you a little bit to develop a more advanced skill little by little, and you know, I promise next trade will be a little simpler, but you also need to see advanced stuff, okay? Oh, sorry, I clicked place order instead of analyze. So I'm just gonna right click, analyze by a ratio back spread, okay? And I'm gonna go back to my 202, right click, analyze by a ratio back spread, which I don't plan to use a ratio back spread, but it's just for me to have the opportunity to have I made a mistake, guys, sorry for that. I should have used a directional butterfly, not a ratio back spread. I got confused for a second. So analyze by a butterfly, that's what I need, because butterflies are 3 legs. So then I will be able to butterfly. Okay, not Iron Butterfly, just butterfly. Notice how butterflies are 1, 2, 3 legs. Okay, and so I'm gonna do this. I'm gonna do this with the butterfly, and what we are doing here, I'll make it positive on the buy. So buy 2, blue color, sell 1, sell 1. Buy 2, blue color, sell 1, sell 1. On the bottom part, I got the puts. On the upper part, I got the calls. Okay, and what do I want to sell? Well, I want to sell, I'm buying the 210 and I'm selling the 207.5. I also need to use the 205, but I cannot because a butterfly will not allow me that. So I need to change it to custom, Okay, so I can pick the 205, and then on the bottom part I'm just gonna sell the 205. Maybe make some room. 205, 207.5, and we are buying the 202.5. So let me explain this one more time. Selling the 207, selling the 205, that's for the puts. Selling the 207, selling the 205, that's for the calls. And then for the protection, I buy the 210 and it's 2 units. And for the protection below, I buy the 202.5 and that's 2 units. Okay? And in order to execute this and have the best fields, I'm going to do it as 2 blocks. One will be the call block and the other one will be the put block. Okay, and because trading platforms normally would not allow you to execute 6 legs in one shot. Okay, so therefore I had to break it down into 3 plus 3. Okay, so now that I have 3 plus 3, okay, 3 plus 3, I'm just gonna come in here and click trade, and I'm gonna go market, because as you know I am using a SIM account which I need to use market, but in your case, you know, knowing that the natural is 275 and the mid is 291, you can certainly always look at here before you place the order, so you can see the midpoint is 299. Ask, you get filled for sure 278. Okay, so maybe you want to go 295, something like that. Okay, and same here. So the natural price would be 139, 152 is the mid. So maybe you try 150, you know, 150, 148. You should be able to get filled. Goldman Sachs is quite liquid. Okay. So I'm gonna go market, as you know, on my side I'll do it market. So place order, 1, 2, 3, yes, and then order field, as you heard, and then on the put side, that was the call side. Okay, and now on the put side I'm gonna do the same trade. I'll make it market. Okay, and here we go. Yes.
Order fill.
So I got those trades in the system. Okay, those trades are now in the system. I got my 6 legs as filled, and the trade is now running. Okay, anyway, so first trade of the day, that was a non-directional trade with Goldman Sachs. That was a complex iron butterfly. It's funny how last weekend we learned about butterflies for the same time, and the first opportunity the market is giving me happens to be a complex iron butterfly. I would have preferred for educational purposes to start in a different way, but that's what the market gave me. Okay, guys, so that's how the trade was taken. Okay, anyway, let me see your questions. Yeah, same amount of calls and puts for the sell, Brian, but double the amount for the protection. Okay, double the amount for the protection. As you can see, we got plus 2x plus 2x. So the protection is double the amount, where the ones that you sell in the middle are 1 only. Okay, good. Yeah, in TOS, Lisa, I recommend you to do exactly the same thing. Just enter the trade as a butterfly, change it to custom, and then you can just pick the strike you want, and that's it. Yeah. And Orlando, yeah, just challenging you healthily, okay? Healthily challenging you. I know you can follow this, okay? I know that, my friend, even though, of course, this is the first time I am doing this type of trade, okay? So, all good, my friends, all good. Anyway, let's keep going. So, what else? Do we have anything else here that could be attractive? So, COP, okay? Well, COP, that's a nice one, okay? COP is a stock related to energy, and the stocks related to energy normally they move, and because they move, normally premiums reflect that. Okay, so I would like to take a look at COP to see what is the earnings date. Okay, and hopefully we can do just a normal basic iron condor on that stock. Okay, and see if this way we can review what we learned last week and at the same time, you know, we bring the temperature in the room a little down, okay, because I know that, you know, I was, you know, again, as I said, healthily challenging a little bit of your thinking, but certainly that was more advanced than normal, isn't it? So July 30 is the earnings report for ConocoPhillips. That means that we could use either July 19 or also July 26, okay? July 19 or July 26. So what I'm gonna do is, before I even think about it, just type COP, okay? And I'm gonna use July 19, right? And also July 26. Those are the 2 dates I said I would be allowed to use. And what I'm gonna do, I'm not even thinking, I'm just mechanically analyze sell an iron condor on the 26 and right click, analyze sell an iron condor on the 19. Okay, so I got those two trades here in the bottom part. I would like to uncheck the 26 so I can begin looking at the 19. Okay, so notice I have unchecked the 26. Okay, so I am focusing on the 19 expiration. Okay, and by doing that, as I did before, I'm just gonna come in here at +1 standard deviation, at -1 standard deviation. This tells me that in a normal case, that stock would be ranging between 63 to 59. That would be a normal case. Okay, good one, my friend. Supply and demand trader, pleasure to see you, and as always, super diligent, executing the trades, and just keep grabbing money from the market. Love it. Way to go. If anyone else in the room is executing those trades, okay, and it doesn't need to be live, if you do it in a paper money account, which by the way, I would recommend you to do that because this trade is a little more advanced, okay, if you haven't done that before. So please go ahead and let me know. It'll make me happy to know, and also somehow it gives me a better feel of what you guys are doing, so I know better what to do to help you better, okay? Wonderful. So anyway, so keep going here. Okay, so we are looking at, as I said, July 19. So from now until July 19, that stock should be ranging between 63 to 59. 1 standard deviation up, 1 standard deviation down, right? And in the chart, okay, what does that mean? So first, I got the 55-minute time frame with regular market data. That's 49. Being a commodity stock, I would expect the pre and post market to give better results. It's about the same, 48.99, just a little better, so it's okay. Okay, and yes, it's a little better, but unfortunately, those UFOs are very far away in that time frame. In the regular session, 48.99 in the normal. Oh, actually, in the normal was a little better. So okay, that makes my life easier. I read it backwards for a minute. So 49.18, and we said, let me add a couple of lines. 1 and 2, the bottom line would be 59.28. So 59.28, and the next line would be 63.25. 63.25. So we need to use UFOs above and below, right? And therefore, the first UFO that we can use is this one below, and the first UFO we can use is this one above. Okay, so of course with July 19, I think I will not get premium enough, especially the 61.83 is so far away. So let's see how much premium we get. It's gonna be like the 66. Okay, yeah, it's no way it's gonna work. Okay, that one is not gonna work because of the location of the UFOs. So 66 will pay you 2. Okay, and if you were to use 26 of July, okay, 66 will pay you also 2. So unfortunately, the chart is giving us UFOs, but they are way too far out. Okay, so even though the trade would make sense with when it comes to probabilities, we will never get paid enough to justify the risk of the trade. Okay, so we are gonna have to pass. Delta Airlines could be another valid candidate. We have Delta Airlines. I would like to check anything else. Merck, we can check Merck as well. It's a biotechnology company, and normally we have some premium, and also UNH and UMP maybe candidates too. You know what? Let's check all of those to see what we got. So Delta Airlines is moving up very aggressively. Let me see. Let me see if we do have UFOs or we don't have UFOs, because that stock is getting close to making all-time high. So I'm not sure if we have UFOs. If we don't, I will not waste any time, and I will go for the next one. I also said I want to look at Merck, so I'll click on Merck so the download begins. I also say I want to use UNH, and I also said I'm going to look at UNP. Okay, UPS also, it's kind of Coca-Cola. Liquidity is good, but premiums normally are a little disappointing. Okay, so back to Delta Airlines. So let me bring this down. Oh yes, we do have a UFO there. So let's begin. Delta Airlines, DAL. So DAL, we are talking about July 11. Oh wow, that's today. Okay, forget about Delta Airlines. No need to talk about the Delta Airlines. Earnings are today, so forget about it. Okay, next one we said was going to be Merck. So let's look at Merck, MRK. So MRK, that's going to be July 30. That's great. Just like what we saw earlier with COP, we can be using July 19, July 26. Okay, so let's see what we've got. Oh, nice. Merck is falling hard today, which probably is also giving a little bit of an extra boost to the premium. Okay, so nice. Let's take a look at Merck, MRK. And by the way, do we know why this is happening? No, there is nothing here, so I guess it's just normal price movement for that stock. So July 19, right click, analyze, sell an Iron Condor, and I just picked Iron Butterfly. Okay, so July 19, analyze, sell an Iron Condor. Okay, that was July 26, and now July 19, analyze an Iron Condor. Again, I'm doing this just to have the excuse to come in here and add +1 and -1 standard deviation, and also careful to uncheck. Okay, uncheck July 26. So therefore, the calculation above has to do with July 19. Okay, so this tells me that that stock should be ranging between 85 and 80. So back to the chart, we got 55% probability with the regular session. If we look at pre and post market, 55 becomes 42. So certainly it's quite clear that stock gets all the orders, all the order cancels, the moment the market closes. Okay, so most of the orders are filled during market hours, not after market hours. The upper part is 85.36. So 85.36. 85.36. The bottom part is 80.70. 80.70. That's what probability suggests. Okay, therefore it seems quite normal or natural to be thinking about using this green UFO as a boundary and using that UFO as the next boundary. Okay, so question is, with July 19, how much I'll get paid with the 86 calls? Let's take a look. The 86 calls will not pay enough, as you can see. The 86 calls are going to pay 9 cents. That is not enough. Okay, what about July 26? Now you get paid 23. Our minimum is 25. I'm not too happy, but also I'm open to be flexible. Okay, so let's go ahead and look at, if instead of using July 19, what if I was to use July 26? Okay, so if I use July 26, the boundaries will be 86 and 79.94. So 79.94, it's a little below this. Okay, a little below this. And the upper part is 86, which is more or less where I got the 86. Okay, so again, when doing non-directional trades, you need to be a little flexible at times. Okay, I would certainly like to move this line down, but if I want to do that, I need to go all the way to the next UFO. Obviously, this trade would never work. So therefore, I'm going to check if I do have an opportunity to do 86.80. I believe the 80 should pay nicely. Yeah, they pay 40 cents, which is a little more than 35. So it kind of offsets the 3 cents I'm missing from the 86. Okay, so this is not going to be the best trade in the world, but it may work. and therefore I'm gonna give it a chance. This will be a trade for 2 weeks, okay, with expiration date being on the 26th of July. Okay, so here we will want to buy the 87 call, sell the 86 call. We are using July 26, 2019. Earnings are on July, I think it was 30, I believe. Yes, 30. Okay, July 30. So we are out before. Okay, and we are selling the 80 put and buying the 79 put right below. Okay, so we are doing a little more advanced stuff here. Sorry, I meant this is not advanced stuff, this is basic stuff. That's what my brain was thinking, even though I didn't phrase it completely backwards. So now let's go ahead and customize it in here. So bottom part we said 79 and 80. So we'll do 79 and 80. And then on the upper part we said 87, 86. So we are doing 87, 86. Okay, that's what we're doing. So what happened if we do this? What happened if we do this? We will be collecting $20+ of premium. Seems to me quite limited. So if we go with the midpoint, that will be $24 of premium. Okay, and remember the premium for us to call this trade to be a valid trade is 15%. Okay, it's 15% of the risk. So when you look at this trade, the risk of this trade, which is the difference between strikes, isn't it? So if I'm doing 86, 87, the risk is 1. If I do 80, 79, the risk is 1. Okay, so the risk is 1 no matter what. So 1, and I want to calculate what is 15% of 1, so I multiply times 0.15. That means that I will need to collect a minimum of 15 cents for me to take this trade and be satisfied with the premium collected. So we just saw that the premium collected is actually more, is 25. Therefore, the trade is valid. So this trade is a trade that we can certainly put in place and execute. Okay, but before I go ahead and take this trade, I would like to give it a try as well by looking at what about if we use the midpoints, because as you can see between 86 and 87 I got 86.5, and between 80 and 79 I got 79.5. So I would like to go ahead and I would like to duplicate this trade. So now I got 2 iron condors, okay, the one above and the one below. And the one below, I'm going to uncheck the one above. And the one below, instead of 79 and 80, I would like to try 79.5 and 80. And instead of 86 and 87, I would like to try 86 and 86.5. Okay, if I do that, I'm getting 15 cents. My risk is now $36 per contract. Okay, my risk is now $36 per contract. So I have less risk. Again, let's do the math the way we have it in the rules. So the rules is that the maximum risk, the distance between strikes is 0.5. Okay, 0.5 is the distance between strikes. Okay, and out of 0.5, I want to collect at least 15% of my risk, which is 0.75. And instead of 0.75, I'm making 15. Okay, I'm making 15. Basically, I doubled it. Okay, I doubled it. Where in the other case, I would need to make 15 and I make 26. It's almost double, but it's less than double. Okay, it's almost double, but it's less than double. So what is this telling you? This is telling you that somehow the bottom trade is doing a little bit of a better job. Okay, now the problem I have, is that let's say I want to do 10 contracts. If I do 10 contracts on the one above, I will collect 10 times 25, that's $250. For me to collect $250 with 14 cents, I will need to do the trade 17 times. So in other words, instead of 10 times, I will need to use 17 times. Instead of 10 condors, I will do 17 condors. What's my concern? Well, with such cheap condors, my concern is the commissions to be paid. So 10 times. Okay, I'm just going to use standard trade station tariff, which probably you have a better deal. But if you use standard trade station tariff, you would pay $1 per contract, isn't it? This is the old school tariff, $1 per contract. So 10 times 4, okay, because every condor is 4 legs. So that's gonna be $40 in commissions, okay? If instead, and then you have to get out, well, you will not get out, you let it expire, right? So you have to pay $40 to get in. The other one, you will need to pay 17 times 4, okay, which is $68. So 68 minus 40, basically you are at a disadvantage of $28, okay, $28 in 17 spreads. So in other words, divided by 17 is like I am suffering 1.64 divided by 100. Okay, it's like I'm being paid 2 cents less. So that 12, that 14 is like it's 12. Okay, if you add commissions into the equation, that 14 is like it's 12, where the 26 is like it's 25. Okay, so 12 is still greater than 7.5. Remember we said if 0.5 is your risk and you want to collect at least 15% of your risk, that's 7.5. Well, you're gonna collect 12, okay? And 12 divided, okay? So 12 divided 7.5, okay, is 1.6 times more, where 24, or I should say 23 divided 15, okay, it's 1.5 times more. In other words, still better to use the bottom one, okay, and I explained that very quickly. Maybe you need to watch this recorded one more time. Those two trades are almost the same story, okay? In the one above you would do 10, in the one below you would do 17 units, but bottom line, the one below, it's just doing a little better when it comes to the performance and when you compare the risk and the reward. It's almost the same, it's almost the same, it's just a little better. So because of that, I'm just gonna go with the bottom one, and this is a valid trade to take. Okay, this is a valid trade to take. Again, ask is 6, mid is 14, bid is 22. So certainly with such cheap iron condors, you know, I would definitely go for the midpoint. And if you get filled, you get filled, and if you don't get filled, you don't get filled. So shoot for 15, guys. Don't go for 12 or 10, or don't. Let's keep it high quality. I'll go market because it's a paper money account, but don't do that in the live one, please. Don't do that. That will make no sense. Okay, so I'm just gonna place the order, okay, and go ahead and click.
Order filled.
So I just got filled on the Merck non-directional trade. Okay, here we go. We have it. 2 trades in. Hey, you guys have been silent for a long time. Say hi, please. Let me know you are still there, you are still alive, and everything's clear. If it's not the case, if you have any question, please let me know. In the meantime, very quickly, I would like to jump into the next one, UNH. So let's see what we have with UNH. While you guys are typing your question, if any, I will start looking at UNH. Okay, so UNH, July 18. So with UNH, we can only use tomorrow. And again, good news, that stock is a pretty high price point stock. So that could work, okay? The only problem I have, actually I don't have any problem. So I don't know why I was thinking that stock was making all times high, but I was wrong. So we have UFOs above and below. So that is, my friends, is exciting. Cool. Yes, and today I'm feeling a little bit like I'm flying. Okay, guys, and I was really looking for sessions like that where we have covered more advanced topics, and I have no technical issues, and I can just go for it. Okay, so if I'm just going a little too fast, and that's because I'm excited, so you can always use the recording. Okay, and if it's really too fast, please feel free to let me know on the chat box. Okay, so I'll know for next time to cool down a little bit. I'm certainly happy to adapt to you guys. Okay, that's why I'm here. Okay, but at the same time, I also healthily like to pull you towards my speed if possible, so you become more and more advanced as possible. Okay. Yeah, so with UNH, very good, Dirk, absolutely. The earnings is happening in a way where the only way we can do UNH is use tomorrow expiration, okay? So again, you have heard me say that before. When you look at trades to be executed tomorrow, many times we don't have the premium we need, but the days you do, the trades happen to be amazing. Okay, so it's always worth it to check, and that's what we're gonna do. Okay, so July 12th, again, as always, analyze sell. I'm just gonna enter an iron condor, not even thinking about it, I'm just entering it. So this gives me the opportunity to look at my standard deviations, 262, 257, okay, 262, 257, and therefore we are talking about those 260 something. So we're going to be looking at the 264s, and then we're going to be looking at the 257s, and the 257s, that's a problem because we have nothing green around here. Okay, nothing green around here. Okay, now we may have some green show up in that region once this candle closes. Okay, and that would be what would that be? That would be around 245. So how much I would get if I do the 245? 245 is paying me 3. Okay, so forget about it. UNH is not going to work using tomorrow expiration date. So we will pass on UNH. And the last one is UNP. So looking at UNP now, UNP. Yeah, Lisa, for the Goldman Sachs trade, there is nothing to be done. It's either you profit, it's either you lose. It's being the fact that tomorrow is the expiration date tomorrow. We cannot do that much control. We cannot do anything. Is that making sense? We don't have time. Time decay is going to be so fast. We got the full advantage. And if Goldman Sachs was to move aggressively against us, then we will end up in a loss. Okay, that's the downside of using 1 day, 2 day to expiration. That you cannot do anything to switch to damage control mode. You cannot. Okay. The good news though is that you saw it was like $64 of time decay per day. That's pretty nice. Okay. So we have UNP. When looking at UNP, earnings are on the 18. So same story. We're going to be looking at tomorrow expiration, which many times would not work, but we'll see if it does. It's always worth it if it does, because the probability is very high in our favors. So looking at +1 standard deviation, looking at -1 standard deviation, that's 170 to 168. So 171 to 178, something like that. So 171 we have here, and 168, wait a minute, we got 49, that is the regular session. Pre-post market is 44, so that doesn't work, so we need to use regular. And regular, if we go below 168.86, well, yes, you could certainly use that one. It's very, very tight. So let's see what we get paid. 167.5. Yeah, we get 16. We don't get the 25 we need. Okay, so yeah, both UNP and UNH will not work. Okay, therefore in these last few minutes, actually we just reached the top of the hour, but I want to take a look at directional trades, at least one directional trade, to see if we have any opportunity to do a directional trade. Let me see what we have. CRM. Let's take a look at CRM. Very liquid stock. Okay, so very liquid, but we are quite far away from the average. So let me see if I can find something that actually we can execute a little sooner. Nike. So Nike, prior close above, it's a little further away. Let me see, WBA. I always start with the most liquid opportunities, as you know, very far from the average. Okay, so I mean, it doesn't mean the opportunity is not valid. It's just that you have to wait. Yes, Lisa, nice one, and thanks for asking. Okay, I'm just reading your last note. Thanks for asking. That's what you guys should be doing. Okay, because you know every question is valid. Plus, not only you're helping yourself by clarifying it, you're helping everyone else who didn't think about it or who has less practice trading options. Okay, so thanks for that, Lisa. Okay, and everybody, ask your questions, please. SQ. Let's take a look at SQ. Very far away from the average. So Shopify. This is a new fancy stock that is becoming more and more liquid. Oh, that one is closer to the average, so we may have something to plan here. Let me take a look at the liquidity for Shopify, because options are becoming nicer, but again, it's let's say a pretty new stock, so always need to be a little in the skeptical side. So if I was to look at let's say, for example, August, what liquidity we have here, 1940, 1918, 50 cents is a little painful, guys. What about if I go to October? So 20, 80. It's not bad, but for short-term trading as well, 580, 630, it's 50 cents. It's just a little too much spread, guys. Just a little too much spread. And you may get surprised that you get filled at a better price, because market makers probably want to motivate more trading of that stock. But yeah, I'm a little skeptical now when I see those spreads. Okay, so I'll look at MasterCard, and then I'll look at Adobe, and if we have a trade, great, and if we don't have a trade, then we'll call it a day. Okay, so MasterCard very far away from the average as well. Adobe a little closer. Yeah, a little closer. Adobe could be. So let's see. Adobe. Well, Adobe is fine with liquidity. That is something that we know. So ADBE earnings for Adobe will be September 17. Okay, September 17. That's I'm a little skeptical here, guys. I'm a little skeptical here. So we got June was the last time earnings were reported. The one before was March. That's 3 months. So 3 months after June should be August, but we have no August. Okay, and it's pointing at September. Well, I guess that they're taking a little break during the summer. I don't like when I see that, because it makes me feel that anytime they can change the date. Okay, so I'm not a fan of that. Okay, but anyway, that's what we have. So the date to be used would be September 20. We need to calculate the TTT, which I will, but that would be the date to be used. Okay, so we got in the regular session we got 49.16. If I look at pre-post market, we got 47. So better using regular session for Adobe with 49. Let me add a little bit of subgraph margins above and below. I like better how the charts look with a little bit of space above and below. Here we go. And good, so we have it. And now what we're looking for is that we are looking for entries around 302. That's what we're looking for. And 302, we have nothing. Okay, we have nothing, but we have 303, 304, which I'm gonna call it valid. I'm gonna call it valid because tomorrow that average will jump up. That average will move up tomorrow as Adobe closes above the average. So it's gonna move up. And remember, we don't need to be too precise with stocks with the lining up of the average and the green UFOs. Since stocks are depending on other forces such as the S&P, the sectors, etc. You heard me say a million times stocks are fragile, and therefore it's okay to be flexible. So now the question is, if I was to take this trade, given the fact that we have a close above the average, we have the DMI is blue, so we have a strong market condition. The question is, where would you take your profits? So I enable my UFOs, and I'm going to look at my UFOs in a weekly time frame and see where is my next weekly UFO. Okay, so I'm going to push this thing down, and interestingly enough, it seems that I got nothing. Okay, so what if I do daily again? Let me push down. Okay, so why is that? Let me go back to the middle chart where I have the candle so I could understand everything better. Oh, here we go. So I think, yes, we are dealing with a stock that is making all-time high. That's what it is. I was not aware that Adobe was in that position, which is a great news. Okay, so disabling the UFOs on the bottom chart, and therefore in this trade we're gonna take this trade with no targets. Okay, we are just gonna be planning on moving our exit point below the green UFOs as new green UFO forms. Okay, so if this market comes down, we'll get into the trade, and now as it goes up, every time a UFO forms above the entry, okay, every time a UFO forms above the entry, we will be moving our exit to below those UFOs, below those UFOs. So if that market anytime was to go below a UFO, this would set our exit, okay, because that price point would be below the UFO. Okay, so that would be how we're gonna deal with this trade, because it's making all times high, and therefore you saw it on Starbucks, you saw it on American Express. Those stocks can really push strong, and you know, you don't want to take profits too soon. Okay, so that would be the plan. Therefore, by looking at the option chain, we are not going to use any TTT calculation because there is no target, so no TTT calculation. We are just going to use September 20 expiration because it coincides with the earnings report, so we'll exit before earnings. Current price is 307, so we'll go ahead and buy the 310. So that's a very easy to plan trade. Let me write it down for you guys. We are going to buy the 310 call, which is September 20, 2019 expiration, okay, and we will buy that call if Adobe drops back and hits the 304.60 green UFO. That's the trade. Okay, don't buy the call yet. Wait until it drops back to the 304.60 and then buy it. So how do we place this order? Simple. I'm just gonna click on the 310, just click buy. Okay, I will click activation rule. Activation rule based on price. The price I use as a reference is Adobe. Adobe needs to be at or equal than 304.60. That will be the triggering condition for TradeStation to buy. Again, because I'm using a paper money account, I will use market. I will place my order. Yes, 1, 2, 3. The order is in the system. Notice this one didn't get filled. If I look at my manage, okay, on the upper part, okay, I have a received order, buy to open, Adobe. Okay, that one is waiting. The other ones are filled. Okay, the ones I did with the Goldman Sachs spread and Merck, those are filled, but not Adobe. That one is received and waiting to get filled until Adobe drops to 304.60. Okay, so anyway, this concludes the session, my friends, and hopefully it went well. I know today was a little more advanced, so hopefully you guys are welcoming the challenge. Again, feel free to drop a note to us on an email in case you don't feel comfortable commenting on the comment box here. If it was a little too advanced or I went a little too fast, I do want to know, guys. Okay, I do want to know, and I could understand maybe you're not fully comfortable, in the group to ask me to slow down. But if you need it, please make sure you let me know. If you don't let me know, I will keep this pace. Okay, and hopefully I can get more and more advanced through time. But if I'm losing anyone, I do need to know, because this is 100% not my intention. Okay. Supply and demand trader, I'm planning to put the Adobe long in, as it is also supported by the broad market S&P. Exactly. And someday we need to talk about portfolio management. So we will talk about how many trades should you be long at the time, how many trades should you be short at the time, depending on the broad market, etc. Okay, so good point, supply and demand trader, as always. Very good points. Love it. Anyway, everybody, you guys take care. See you over the weekend for sharpening. Don't miss it. And by the way, click the thumbs up on the YouTube channel. And if you haven't subscribe, click on the bell. Especially if you're watching this recorded, make sure you subscribe and you click on the bell. So next time you are informed, you are notified real time when the session begins, so you don't miss it. So you don't need to watch it recorded. You can watch it live. Very good. Wonderful, everyone. Love it and love the interaction, guys. Okay, keep up the good work. Okay, and we'll go very far all together. Take care, my friends. Bye bye. See you over the weekend.